Hello, welcome to another video. Today we're going to talk about multi-time frame analysis. So what is multi-time frame analysis? Multi-time frame analysis is the process of looking at the chart across multiple time frames to get a clearer picture of market direction and behavior. For example, analyzing a trade setup on the 50-minute chart, but also checking on 1 hour and daily charts to confirm the trend and structure. Why use multi-time frames? So it avoids the tunnel vision from only one time frame. Because if you're only trading on one time frame, you're basically just trading around that, but you cannot see the overall structure of the market. So it helps you with the direction of a larger trend. So it confirms or filters entries based on high time frame context. Because if you know where the high time frame is heading with a lower time frame, you can kind of snipe entry your trades in confluence with a higher time frame. So it does help identifying key support and resistance levels or zones of interest across multiple time frames. So the simple three level framework is a structure very simply. So we use the high time frames as a trend direction and key levels. For example, on the daily and weekly time frames, so we can identify areas of value of support resistance, either static or dynamic. And then on the mid time frame, we can look at structure and confirmations to which we can see a mid overall of how the price is moving. And then on the lower time frame, we use a 50-minute or 5-minute charts to which we are going to time our entries. So if we do go through the markets, we can go like, for example, on the Dow Jones. So if we can start on the weekly, we have areas of value to which we can identify of multiple places. Support and resistance, static over here, give it a take over there. So basically what we can do is on the higher time frames, just identify keys of interest where the price has reacted previously, and then go down on lower time frames and then try and see how the price is moving on those occasions. So let's say if we go around here, we do have a price reaction of this area. If then we go on the 4 hour time frame, we can see that the price has reacted to the downside and then gapped to the upside. Since it has gapped to the upside, we can recognize that the price is moving to the upside impulsively because it made a V, and therefore it will most likely continue to go up. As we can see, it's moving impulsively to the upside, and then if we go, we're not able to reach that about an hour. If we go on 1 hour after this impulsive move to the upside, we can see that the correction has been pointed out over here. And therefore, if it would break down, we will most likely set up an entry over there and have some profit. However, as we can see on this occasion, the price has moved, gapped it massively up, and therefore didn't give us an entry. However, we do get another descending channel or bullish flag, because if we do take account into this impulsive move to the upside, we do have a correction to this side and then a breakdown of this pattern over here. Set up a trade, depending on our risk, just set up our risk at some point and then, move our TP higher. Don't know if it's going to go up or if it's going to go down, because as we can see, we can, time our entry to that specifications and then allow the market to either go up or go down. Let me see if I allow the market to play out. And then until either hits our stop loss or TP. It's at the time being, it's not hitting anything. This is basically what we do with multi-time frame analysis. We see how the market is reacting. And then, as we can see, at this occasion, it's hit our TP. Same thing to the downside. If we go on the weekly again, take our to the end of the market. Let's see another on this resistance there. We do have a reaction from this area. We go down to the 4-hour time frame. As we can see, the price has been reacting this way, has broken down over there. Move impulsively to the upside. Then if we go on the 1-hour time frame, we can see that we have formed another descending channel, broken down over there. So we set the trade, say 1.5%, then do a 2-to-1 risk reward trade. Oh, excuse me. If we allow the trade to work, be quicker. There we go. It hit our trade, and therefore we are happy as a Larry. As we can see, we can use multiple time frames to build confluences around what we expect from the market to react, and therefore have higher probability setups on our trades. As is at the time being, this is basically very simple. We break down the markets from the top down, and we do a top down end analysis. So we start on the daily or weekly, move down to the 4-hour time frame, and then you can either use the 1-hour time frame, 15 minutes or 5 minutes, according to your strategy, which you need to backtest to see if it works or not. This is basically multi-time frame analysis. I hope you enjoyed and have obtained some valuable insights with this explanation. Please comment down below and make any observations that you would think that I might need to improve myself on my videos. I'm just starting, literally trying to teach other people what I know. It's not very straightforward. At the same time, English is not my first language, and therefore I can struggle sometimes to express myself. But as it is at the time being, I will try and continue to improve myself so that you guys can obtain more insights of my teachings. At the same time, I would just like to add that I do put my mouth where my money is. So that means that what I'm teaching you, it's what I'm using overall with my strategy. And at the same time, I hope I do help you out somehow with some valuable insights. Thank you very much for watching another one of my videos. Thank you. Hope you enjoyed, and see you next time.